Hey, what's up, guys? Let's talk about credit spreads. One of my favorite things in the world, pretty much. So, if you've been a subscriber for a while or you follow me over at Simpler, you know pretty much every trade I take is a general statement, is a credit spread. So, I want to talk a little bit about the timing component of a good entry when you're selling a credit spread. And we can use Netflix here in a recent trade that we did in my mastery as an example. But the major thing you want to focus on, really keep it simple for yourself. And never mind, selling credit spreads, just buying a stock in general. So you might buy shares of the stock, you might do a debit spread, you might buy calls. It's just very beneficial to build your long position as the stock is coming in a little bit. So think of it this way, as everybody is chasing Netflix up here at 3/8 AR, on that little pullback there, the pullback that doesn't ruin the uptrend, the pullback doesn't change the structure, that doesn't kill momentum. It's just a little pullback here, but because they're chasing up here, at the moon, they're catching a pretty good spanking. And we can definitely use that to our advantage. But just thinking in terms of, basic options pricing, as Netflix is pumping here from 620 to borderline 700, obviously the calls are just exploding. So the calls are gaining value, premium is going through the roof, but on the other side of the options chain, those puts are getting smoked. So just imagine you bought a put on Netflix back here at 620. You're not enjoying that, 4 to 5 to 6 day rip. So as the stock gets extended to the upside, the puts are getting crushed, all premium is getting sucked out, and the calls are just gaining premium like crazy. But then when you get that flush, again, the flush doesn't change anything about, the bigger picture trend here, but as you get that flush, the calls, they're getting crushed now. And those puts, specifically the out-the-money puts, they're just getting all kinds of chunky with premium. So, imagine this is your put contract. As Netflix is rallying there, all the premium is getting sucked right out. But then as Netflix makes that sudden, 2-day dip there, those puts are going to catch that spike in implied volatility, and all of a sudden, they're gaining all kinds of premium. But what happens here is, once the stock finds some support, trades sideways, and then curls back up towards the upside, it's almost like a balloon, where all that premium that got pumped in on the way down, it's just going to deflate. Like all that premium is getting sucked right back out. So if you can find an uptrend, and you can find a pullback to a key level of support, like your buy zone here to 21 EMA, you can sell those puts in the spread as they're gaining all kinds of pretty much unnecessary value. And then as soon as your stock just finds support and catches a bid, all that premium is coming right back out, right into your own pocket. So the trade we did on Netflix here was pretty much, it was exactly that. Good looking uptrend. It had been on our radar. And then as you get that flush where it's down 2, 3, 4%, we're coming in here, we're selling a put credit spread. Now we're going all the way out here to 620. So jump back to the chart real quick. We're pulling back to 650. We're going $30 out the money with our short strike. Now the only way that we can go that deep out the money and still get a good risk reward of about 2 to 1 is because of the timing component here. A few days before the flush, if we're trying to sell credit spreads down at 620, the risk reward is going to be awful. But catching that flush there, because those 620 puts, they start to gain all kinds of premium. All of a sudden, there's that little window of opportunity where you can jump in there, sell that credit spread for $1.50, and you're deep out the money, but you're still locking in a really good risk reward. So we did sell the spread for $1.50. Into that flush, so we open the position on the 5th, and then you immediately catch some support, and then Friday, you get a pretty strong move here into the close. So, we're going out to December. Now here's a common misconception about credit spreads. We're giving this trade 40 or so days till expiration. Most folks would tend to think that you have to hold that trade pretty close to expiration to collect any of that profit. We sold it at $1.50. It's already going for about 60 cents. Meaning we get another good push early next week, we're probably walking away with 80% of our max profit. But the major thing I want to show you here is because obviously, in this spread, we're basically just shorting the 620 put, and we're buying the 615 as protection. but we're really just trying to short that 620 put. We're looking at that as a stock that's going to go to zero. But again, the timing component here, if we check out a chart of the 620 put, and remember, we're taking the position on the 5th. So as everything's looking a little bit ugly here, and anybody who's buying up here is definitely feeling pretty uncomfortable, we're jumping on in. So if you look at the chart there of the 620 put, and we can look at a 4-hour chart, make it a little bit easier on the eyes. Right? So check this out. Now, as Netflix is rallying and rallying and rallying, these puts are worth $5 here. They're not worth all that much. But then as you get that 2-day sell-off, Netflix is coming in pretty quick. Implied volatility starts to spike. Really quickly, those puts go from $5 per contract all the way up here to about $15. $14.50. So call it $15. You go from 5 to 15, which, hey, if you bought those puts and you nailed that trade, awesome stuff. I'm more so looking at Netflix saying, hey, this is a good uptrend. 30 days from now, I think we'll be trading higher. In other words, 30 days from now, I think these 620 puts that are going for $14, $15 per contract, I think they're going to get smoked here. And I think they're going to zero. But there's your increase in implied volatility. Right? There's that big pump of premium into those deep out the money puts. So that's when we're selling that credit spread, when that put's going for $14, $15. Then notice how over the next few days, it's not that Netflix quickly rallies back towards the upside. Rather, the stock just finds a little bit of support. In other words, the selling pressure came to an end. When the selling pressure comes to an end, implied volatility dies right back down. So just on that little, catch of support on that IV crush, those puts go from, again, $14.15 to $10. So they lose 40% of their value just because Netflix stops going lower. And then towards the tail end of the week there, as Netflix catches a pretty good bid, they're going for $5. So there's kind of the round trip. Whereas Netflix is just trending higher, there's not much premium here. As you get that little 2-day BS little dip there, they double, triple in value. But remember, the trend never broke. It was just a dip to the 21 EMA. So structure never broke, momentum never broke. Nothing about what makes Netflix so bullish changed. It was still the same bullish trend. It just pulled back for 2 days, which, after the rally it had, it kind of makes a little bit of sense here. That's when you come in, you sell that credit spread. That's how you catch some pretty quick premium. So granted, we're going 40 days out to expiration, but we're quickly bringing home some premium here because of that component right there. If we were to come into Netflix now and sell these, sell that credit spread, it's going to be slow premium. But to do it here as those puts are catching, a big pump, that can really work to your benefit. So hopefully that makes sense. You got to kind of think just in terms of basic options pricing, but then more so just, take that 40,000 foot view of the trend here. Like, that doesn't change anything. You're up here at 3/8 AR. We know anytime we're up there at 3/8 AR, there's a pretty good chance sometime soon we're going to flush to the 21 EMA. So as we flush to the 21 EMA, and as everyone who buys up here is taking some pain, we're going to come in, we're going to take advantage of those puts exploding in value, we're going to sell them to somebody else out there, and then as the stock just continues its uptrend, we're collecting some pretty quick premium. So that's the timing component I think you should focus on when you're looking to work put credit spreads. Something as simple as Amazon here. Right? You're up here at 3,600. You get that little baby flush down to the 8 EMA. The same principles apply here. Do it on the flush, you're getting a little bit more premium, which ultimately, that goes into your pocket, right? But hopefully this is helpful. Hopefully it makes sense. And granted, there's times where, Apple here. Apple's just kind of in a consolidation. We're not really going to get that plus 3/8 AR to the 21 EMA dip. It's just more so a good-looking daily squeeze. I'm still going to sell my put credit spreads here. But there's definitely, definitely an advantage to finding an uptrend, waiting for a flush, and then you're going to sneak on in here, sell some premium, okay? So I hope you find that helpful. Subscribe for more videos like this, and I'll keep you posted on this Netflix trade, our trades in Amazon, Apple, etc. over the next few days.